All right, ladies and gentlemen, good afternoon. It is July 19th, 2022. Today is Tuesday. It's right afternoon here in New York. We're going to begin. So today I am going to go over all the changes that we made to our portfolio yesterday. Some of them I'm already regretting. And I'm going to update the plan as well. There's a lot of data that happened overnight and a lot of movement in the currency markets, and it's actually changing the dynamics of the market. Wow, this market is quick. I mean, talk about really quick. This market will change so quickly on you. So, I mean, even currencies, currency markets and bond markets tend to move very slowly. Things like this usually take a lot of time. It's taking way less time than usual. All right. Generally, this is not something that we see happening this quickly. But hey, it is what it is. Okay, it's not about our opinions. It's about understanding what the market is doing. A lot of you probably have noticed on Twitter right now. There's this tweet going around that's really popular about what is it? The number of days under the 50-day moving average, and yesterday happened to be the 60th day under the 50-day moving average. This usually in a bear market, it takes time to have 60 days under a 50-day moving average. Back in 2008, it wasn't until 13 or 14 months into our bear market that we had that 60 days in a row under the 50-day moving average. Okay, what are we in this bear market? We're in month 6, month 7. So obviously the markets are changing way faster. Okay, it's about twice the speed. All right. Having said that, okay, let's go over some of the changes that I've made. So yesterday we entered the FEZ. So yeah, okay. First of all, yesterday, as you all know, on last week we entered Baidu. All right, Baidu at the bottom, near the bottom here, around 137, 138. We entered some call spreads. Literally yesterday on Discord, I alerted everybody to get out at double the call spread. We literally sold at the top. So that was a very good trade. My sizing of the trade made it such that all the gains now, all my profits, will pay for 2 new positions. We've already started building the Dow Jones Industrial Average put spreads. I legged into some more yesterday. So this full position, plus I opened up the Europe index put options. This and the Dow Jones Industrial Average is now fully paid for by my Baidu profits. It's fully paid for now. All right. And I will probably keep this position as is. I don't think I'll be adding more to it. I think I'm just happy with just giving up profits at this point, rather than putting fresh money into this. All right. That way I can maybe hold on to these a little bit longer. And as you can see here, it popped up against me about 3 to 4%. Just so you guys believe me here. Yeah, I'm not lying here. I did buy this yesterday. So my timing, right? I tend to be a little bit early. You remember I said this Murphy's Law. Remember I fucking said this, didn't I? I said if I'm patient, the market's going to move on me, and if I get aggressive, the market is going to take its sweet ass time. Well, there you go. So I got aggressive. Market wants to take its sweet ass time. It is what it is. That's life. That's trading. Sometimes it happens. I know my tendencies, therefore I always leg in very small at first and gradually build a position out. This is super, super small for now. And again, this plus whatever I've already put into the Dow Jones Industrial Average spread, these are all now paid for by my Baidu spreads. So thank you, Baidu. Okay. So we shall see. We shall see what happens. Now, here's the thing. The dollar, that's what is on everybody's mind right now. Again, it's all about the dollar. Okay? It is correcting, all right? Yesterday, it wasn't, people were unsure whether this was going to go back up or not. But in the early part of Asia's trade, it looked like this was going to rebound, but then it failed. Okay, it failed. So, I think a lot of people were anticipating this. The Euro USD was a very crowded short trade, okay? And I think a lot of people are unwinding it right here. It touched parity, and then it's unwinding now, okay? And that's a massive amount of money that's unwinding, all right? And it's causing the dollar to go up. Also, too, if you compare the dollar to a lot of the emerging market currencies, a lot of the emerging market currencies are rallying almost 2% against the dollar. Let me see if I still have my chart up of the. Oh, I still do. So here is all the dollar pairs out there. As you can see, a lot of the dollar pairs to other markets are, the dollar is retreating. Okay, and by a large amount too. I mean, look at all except for the Turkish lira, but South Africa, all the Poland, Mexico. We're seeing the dollar retreating from them. Okay, and some of these other markets, their currencies are going up, and so that does affect our EEM position as well. And so we're seeing actually our EEM actually go up. Right now, our puts are break even on EEM. We're still at a slight profit for our FXI puts. And I am updating the plan right here. When do we exit? When do we know we're wrong? Okay, I'll tell you exactly when we know we're wrong. It has to do with the Australian dollar. EEM too, because EEM has a large... it's got a large China weighting as well, okay? So this is what's going to happen, okay? This is my level on the Australian dollar as of right now. It's like around 6903, just a little bit above 6900, okay? If we close over 6903, if we close at 6903 or more, I am going to exit FXI and EEM puts. Okay, I am going to exit the FXI and EEM puts if the Australian dollar closes over 6903. Okay, I am going to exit every put position that we've built for the last few weeks if the dollar closes below the 18-day moving average. Okay. Ooh, but Mickey, don't you, how can you say that? You told me that you don't do moving averages. Well, okay. You generally don't. I don't like to predict where prices will go based on moving averages. That's what a lot of people use moving averages for. Oh, if one crosses over the other, we're going to go up to a certain line, or if one crosses over the other, then we're going to go down to a certain line. I don't like to use it as that, but I do like to use it for pivots and risk management. Okay, and as you can see here, for the past, it's just the characteristic of the dollar when we've reached this 18-day moving average, it has acted as a pivot for the last few months. Okay, it's acted as a pivot. Okay, and if it closes below there, I'm just going to manage my risk. I'm still at a slight profit in all of my positions because mostly thankfully because of Baidu, it paid for two positions. Again, it paid for my Dow Jones Industrial Average puts, and it paid for my Eurozone Stock Index puts. So if I exit out of those are automatically full. All that is just profit. I'm still at a slight profit on my FXI position as a whole, and I'm about break even on my EEM. So I have a little bit of profit in there. I'm willing to just walk away with that if we close below here. Okay, if we close below this 18-day moving average on DXY on the Dow Jones, on the dollar index, I'm getting out of all of those put spreads, all of them. Okay, all those puts on those risk assets, I'm out. I am out right here. All right, the Australian dollar, that one is only my trigger for FXI and EEM, guys. Okay, so again, this is for FXI EEM puts. All right, and the dollar here is for all put spreads. I'm just getting out right there. Okay, and then we'll wait. We'll have to wait. Okay, and again, and I think what's going to end up happening is if the dollar drops that hard, I think we're going back up here. We're going up back here. Okay, remember how I told you guys that if you take out the dollar's influence on the indices, that the chart looks completely different. Okay, I'm about to pull that up for you guys. Hold on, give me 1 second. Let me show you guys what I'm talking about. All right. Let me show you guys what I'm talking about. This is the S&P 500 priced in euros. SPX divided by Euro USD. Okay? As you can see here, if you price it in euros and you get rid of all that dollar noise, the market went back to its June highs. Okay? The market literally went back to its June highs. It retraced it if you price it in euros. Okay? So that's why I think if the dollar drops, I think we go back. I think we go here easily, 415 or so. All right. So I am not going to be buying puts at 395. I'm going to wait for that 415, 420. Okay. I'm going to wait for this zone. So we're going back to our old plan pretty much. All right. So we're going to start legging into some puts here if the dollar starts dropping. All right. So I just want to make that very clear. Now, downside, it's still going to be the same. I am not changing any of these lines yet. Okay? I have no reason to believe that these lines have changed at all. Okay? So I'm not changing any of this, but I will be changing where I buy my puts. I'm going to stick to my strict levels, and I'm only going to start buying those puts at around this 410. What is that? Yeah, 410 to 415 zone. 410 to 415. On the SPY, okay, on the SPX, all right, it's gonna be around that 4120 to 4160 zone, all right. So that's where I want to start building those puts, okay. So that's the change in the plan so far, okay. And again, I mean, we're very close to those levels. We may as well very well close over that today. And if that happens again, I'm going to make the necessary changes. I mean, that's trading. That's part of life. You're not going to win every single one of them. It's all about risk management. It's all about protecting your capital. So that's what I plan on doing. I'm just going to protect my capital. If we're wrong, we get out with just a slight gain. Hey, how many people can say when they're wrong, they still walk out with a small gain? All right. So, it's all about really protecting that capital and reassessing what's going on. Okay, so that is what I see. All right. I mean, there's a lot of conflicting, pieces of information too. I mean, if you look at the high-low line too, it still hasn't curved up yet. All right, this is the new highs versus new lows, the cumulative line. It hasn't curved up yet. Usually when you want to see the end of that, when you want to see a sustained rally, you want to see this actually curl up. And back in the May and June bear market rally, it never actually curled up. It never did. All right. Even though that monster rally, it never curled up. It still kept going down. It still pointed down. So, I mean, we'll see. Maybe things change at the end of the day today. I'm going to keep an open mind and just take things one day at a time. Okay? One day at a time. If we look at some other pieces of data too, TIP over TLT, We're going back up. We're still in that no man's land. All right, we're still in no man's land. We're good. You're chopping up and down. You know, we are off our highs though. We'll see what that does. You know, I'm not seeing the 30 and 10 year getting any better either. And then if you look at the 10 and 2, all right, it's getting more inverted. So maybe this is just temporary, okay? And again, I'm not trying to predict the future here. I'm just anticipating what could be if we're wrong, okay? There's nothing dumber than thinking you're going to be right at all times. That is just not how I trade. That is not how you should trade. If you want to be in this business for a long time, you always have to doubt. You always have to look, and you always have to reassess. Okay? Oh, look at that. It's already pulling back from this level. So maybe we can just keep our positions. We shall see. Okay? Risk management. Everything is still very small. I am now, I think, about 93% cash. All right? I'm 93% cash still. All right? And again, 2 of my positions now are all paid for, thanks to Baidu. So we'll see. Okay? We'll see what happens here. I promised you guys that I would also show you guys how to use Bollinger Bands. Let's do it actually here. So Bollinger Bands, you know, what is a Bollinger Band? So a Bollinger Band gives you where, you know, out of a distribution, okay, out of a distribution of between from a moving average, all right, and generally what's used is a 20-day moving average, but basically what the Bollinger Band implies is out of a distribution of possible outcomes, prices that are within 1 standard deviation or 2 standard deviations of a moving average. Okay? So that's what these lines are. The red lines here, the red squiggly lines, are 2 standard deviation Bollinger Bands. And the white line is a 1 standard deviation Bollinger Band. Okay? 1 standard deviation is about 2/3, about 65-66% of all outcomes. So it's saying that, you know, with a distribution of of outcomes of different prices, 66% of the time you can expect it to fall within this white line. With the red line, 2 standard deviations, that's 95%. So this, you know, out of a distribution of possible prices, 95% of the time they're going to fall within these red lines. Okay. I use it for risk management, and so do a lot of professionals. When I used to work, in the industry, I know that a lot of the senior traders used the two standard deviation Bollinger Band, but they would use length 18. The standard Bollinger Band comes at length 20. Okay, they don't use length 20. They use length 20. They do. What's going on? Yeah, for the 1 standard deviation Bollinger Band, they do use length 20. But for the 2 standard deviation Bollinger Band, they use 18. I don't know why. Don't ask me why. I just know that that's what's done. Okay? And generally what happens is what they use this for is to take profits in momentum. All right? When you're in a momentum move, all right, if you're riding momentum, generally, you know, what a lot of professional traders would do is take profits at the 2 standard deviation, upper 2 standard deviation Bollinger line. Okay? And in times of momentum, they would also buy their initial buy was at the top line of the 1 standard deviation Bollinger Band. Okay? And if that broke, they stopped out and they waited for it to touch the bottom 1 standard deviation Bollinger Band. They would enter there, and they would lag also in the bottom 2 standard deviation Bollinger Band line. And they would ride it back up and take profits at the top 2 standard deviation Bollinger Band line. Okay, so that's how a lot of traders use this for a lot of professional traders use this for risk management. Again, when it hits that top line, you take profit. If we're in a momentum grinding phase, we use the top 1 standard deviation Bollinger Band line as the re-entering. If it pops below there, you stop out and you wait for either the bottom 1 standard deviation Bollinger Band line or the 2 standard deviation Bollinger Band line at the bottom. And then you ride it back up to the top of the line and you take profits there. Okay, so that's something that we see often. All right, you see here too. Oh, look at that. Look at that. That bear market rally. Look at that. Some options traders also use this too. What they'll actually do is they'll buy options when the Bollinger Bands are very narrow. If it narrows and it extends itself for a while. Here, let me see if I can find something like that. A narrow Bollinger Band that's kind of flat. Let me see. Oh, so like right here, for example, right here. So you see how this is all coiled up and it's really flat? Right here is where they'll buy options. They'll start selling options when the Bollinger Bands are very wide. That means volatility is high. Okay, it's also their volatility signal. All right, so that's how a lot of professional traders use this. So I just wanted to share that with you guys because I've been getting a lot of questions about Bollinger Bands and how to use them. So there you go. Okay. Next, what else did I tell you guys? Oh, let's go over cryptos. Everybody's talking about cryptos. You know, it's very exciting, right? First off, let's look at Bitcoin to gold ratio. Remember when I pointed this out last week? I was like, ooh, it's making higher high. It made a higher high, higher low. And I said on Monday or Tuesday, if it continues, we're going to see another higher high, our second higher high. Well, lo and behold, look at that. We got our second higher high. All right. So I don't know what to make of that, man. To be honest with you, I don't know. I don't know what's going to happen. Is he going to keep going up, or is this just a little corrective phase and is going to come back down? I want to be patient, but it's hard to be patient when you see this. We shall see. Okay. Now, one thing I did notice yesterday and the day before was that I noticed that we had some pinning going on, some gamma pinning. Yesterday, and even earlier today, yesterday and the day before, it looked like 22,000 was going to be our gamma pin for later this week. All right. Now, gamma pins, how do they work? And why is this not a gamma pin? Now, gamma pins are gamma pins until they're not. All right. Gamma pins will stay a gamma pin until the order flow drastically changes. Okay. So first of all, let's go over what a gamma pin is. And then I will tell you why the gamma pin was lost. Actually, it was lost today, right before the video started, actually. That's when it got lost. And I will go over that with you right now, okay? So I made a little slideshow here. Ooh, fancy. Okay, so gamma pinning. So first of all, what is gamma? Okay, so gamma expresses the change in your delta of an option for every incremental move in the underlying. Generally, it's for every 1 point. For stocks, that would be $1 if you're here in the United States. All right. So for every $1 move, how much does your delta move? All right. For every dollar, every point on Bitcoin, how much is your delta of your option moving. That's what gamma expresses, okay? For those of you that are math nerds, it is your second derivative of your price function, your first derivative being delta, okay? So you can think of delta as like your velocity of your car, and then gamma is like your acceleration, how much your velocity change, at what rate does your velocity change? That's what acceleration is, right? So that's your second derivative, right? So for you math nerds out there, okay? If you don't understand what that meant, just know that gamma is, just remember this part, okay? Just gamma is the change in delta of an option for every incremental change in the underlying, all right? So I just give you an example right here. Let's say you have a call option at delta 0.5 and you have a gamma of 0.1, all right? If your stock moves up $1 and everything else stays constant, like, you know, it's not a different day, it's the same day, volatility doesn't change, all the other variables that go into pricing an option, none of those change. If everything is held constant, then the new delta of our option after the price move is 0.6. Okay? So the opposite of this is if you have a call option for delta 0.5, gamma 0.1, same option, but it moves down $1, then instead of your option delta being 0.6 is going to be 0.4, right? Okay, so that is the how you use gamma and delta. Now, again, this is super simplified, just for example purposes only. Okay, so for super simplified, all right. So generally, when do we have a situation where everything is just constant? That only exists in the theoretical world. In the real world, every variable is moving constantly, okay? So again, this is just super simplified, all right? I go over another example for a put option. Put option, same thing. Your put options have a negative delta, right? Call options usually have a positive delta from 0 to 1. Put options are negative delta from 0 to 1. So if you own a put option and it's negative 0.5 delta and it's got a gamma of 0.1, if the stock moves up $1 and everything else is constant, then the new delta of our option after the price move is 0.4, right? When a put option, if you own a put option and the price of the underlying, because a put option is a bearish position, right? So if your stock goes up after that, your option gets worth less, right? So your delta goes down, all right? Now, same thing, if your put option, you know, if you got the same put option, delta minus 0.5, and you have a gamma of 0.1, and your stock moves down $1, okay, then the new delta of our option then would be negative 0.6. Actually, that should say negative 0.4 if it moves up, right? Hold on. Let me change that. Okay. Okay. All right. Oops. So that is now correct. All right. So again, put options have a negative delta. So if it goes up, you add 0.1 to negative 0.5, you get negative 0.4. If it moves down $1, well, you take negative 0.5 and you subtract 0.1 and you get minus, negative 0.6. Okay? Is that clear? Thumbs up or thumbs down, voice chat, text, or on Twitch or on YouTube. I'm looking at all three right now. Thumbs up, thumbs down. Do we all understand this? Thumbs up. Good. Okay. So you all understand. Okay. So, and again, just think about this. Think through these examples. Okay. So if you don't understand, if you don't want to, if you're shy, just, rewind the tape, go over that example again, and just read through these examples. Okay. Now, here's the thing about gamma. All right. Gamma increases drastically on close to at the money options as we get closer to expiration. Okay. Remember back in the day when the VIX was a little bit lower? Remember how we used to play those zero DTE SPY calls and puts? For those, for those of us, for those of you guys who've been with me for a while now, what you're really doing was taking advantage of how gamma affected delta in the last 30 minutes of the day on the expiration days. Okay, that's really what we were doing. All right, we were just taking advantage of that gamma explosion. Okay, so gamma drastically it goes up, so which means that deltas change very quickly for close to at the money options as we get closer to expiration. Let me say that again. Because gamma increases drastically as we get closer to expiration, deltas of close to at the money options also change drastically as we get closer to expiration. Okay? So what did I tell you about market makers? What is the number one job of a market maker? Is to facilitate trade and to take the opposite side of the trade, which means they have to have a bid and ask, which means they always take the opposite side of the order flow. All right, and they always remain neutral. How do market makers make money? They make money off the volume, off the bid-ask spread. Okay, they don't take a directional bet usually. They want to remain neutral. They want to remain delta neutral. Their delta, at the end of the day, they want their delta to be zero. Okay, with all these pluses and minuses, it all has to equal out to zero. So when your delta is moving so much, how do we hedge that? Well, here's the thing. All right. So let's go over an example. Okay. And this is in the perspective of the market maker or the institutional trader. Okay. If a trader owns a delta 0.5, gamma 0.05 call option, okay, that means that they are hedging with 50 shares short of the underlying. Now let's conceptualize this, okay? If you are long a call, in order to hedge on that long call, because a long call is a bullish position, you would need a short position on the underlying to neutralize it, right? So that's why when you're long a call, to hedge, you're going to be short those shares or short Bitcoin, okay? So delta tells you how much your option price changes based on a 1 point movement in your underlying, okay? So if you have a delta 0.5 option and it's a call, and you own this, if price drops by 1 point, your option will go down by a value of 0.5. Okay? So how do you negate that? Well, in options and stocks, each option represents 100 shares. So if you have a delta of 0.5 and your price goes, let's say your price goes up, the stock goes up $1, well, now your delta is 0.55, right? Because your gamma is 0.05. So you went from a delta 0.5 option to now you're a delta 0.55 option, okay? But you're only short 50 shares, okay? So as the price goes up $1, right, you've gained $1 on your option, right? You've gained $50 on your option. So to hedge that, you're gonna have 50 shares short. So you lost $50 on the underlying, right? So when you go from zero, so now to hedge at this point at delta 0.55, you have to short 5 more shares to remain neutral. So as it goes up, as the delta increases drastically, the market maker has to sell more of the underlying, and so that's why price comes back to its pin. Okay, So this option at 0.5 is strike 100. So generally when your delta is at 0.5, that's an at the money option. Okay, at the money options are generally 0.5, the delta. All right, you can think of it as it's got a 50-50 shot of being in the money or out the money, right? Because it's right there, it's right on the line. Okay, so we're at strike 100. If your call option goes up to or the underlying goes up to 101, now your delta is 0.55 based on your gamma. All right, and so now to remain neutral, you have to short 5 more shares. All right, now same thing in the other example. Let's say you own those calls at 0.5 delta, gamma 0.05. You're short those 50 shares to hedge and to remain neutral. If your call, so let's say you're at this point right here. I don't know if you can see my mouse cursor, but right here, if you're at this point right here between 2 days till expiration and 1 day till expiration, if you're right here at 100 and prices fall, well, now your option is at 0.45 delta. You've lost money on your option, but you gained money on your 50 shares short. So you lost $50 on your option, but you gained $50 on your short position. That's because you're neutral. But now at this point, in order to remain neutral, you have to buy 5 more shares to cover because your delta has been reduced on your call option. Do you see that? And so because you're covering 5 shares, you have to buy, it comes back to the pin. It comes back to the pin. So this is why pins happen, all right? And the same thing with puts, all right? If you're in a delta 0.5, gamma 0.05 put, if you own a put, to hedge that put, you're going to be long 50 shares, right? Because a put is a bearish position when you own the put. So you need to have a long position to remain neutral, all right? So let's say you own the 100 strike and it's at 0.5. And let's say price goes up from 3 days till expiration to 2 days expiration. We see the put will go from 0.5 to 0.45, right? Because we lose value on that put. But luckily, we had 50 shares short. We had 50 shares long. So even though we lost money on the put, we gained money on the long position. But now that our delta is 0.45, we actually have to sell 5 of those shares to remain neutral going forward. And that's why when we sell those shares, the selling pressure causes us to go back to the pin at strike 100, the at the money pin. Same thing. If we're here between 2 days expiration, 1 day expiration, we're right here at 100. Same thing, same puts, delta 0.5 puts at gamma 0.05. We are long a put and we're short 50 shares. We're long the put and we're long 50 shares of the underlying. If the prices come down, our put has just gone from 0.5 to 0.55. Okay? And now, in order to remain neutral, they have to buy 5 more shares to remain neutral at delta 0.55. And again, it's going to put that pressure to go back to the pin. All right. Now, I hope to show Bitcoin as the example of that. I was hoping that the pin would remain intact for this presentation. But that is not the case. Oh, okay. First of all, let's go back to that. Why is it that the pin doesn't remain? So here's the thing: as long as the volume of this options activity, of all this pinning, as long as the volume of that exceeds the order flow volume, the pin will stay until expiration. Again, if the hedging activity, the volume that's caused by the hedging activity, if that is significantly higher than the order flow, if there's not much new order flow coming in, and it's just a boring market day, that pin is gonna hold until expiration. Okay. Now, when does the pin not hold? It's when new order flow comes in. Okay, and we saw new order flow actually coming in right before the video, actually about an hour or so, maybe a couple of hours before the video started. We saw huge amounts of our order flows coming in. Actually, I'll tell you which order flow is coming in. A lot of the 23,000 calls it's almost like they're sick and tired of buying the 22,000. Now they're getting even more bullish at 23,000. So we saw even more call buying. New order flows came in, much more heavy in the call buying area. And so what did I tell you guys? If there's a lot of call buying order flow coming in, what does the market maker have to do? The market maker has to sell those calls. If the market maker is selling calls, that's a bearish position, so they need to buy Bitcoin to remain neutral. Okay, so that's why we kind of got rid of our pin, and now we're still rising. Okay, we're still going up. Okay, but we did have a pin situation for the past few sessions, or past couple of sessions at least. Yeah, right here we had, well, let's not look at the hourly. It was less than, yeah. So from, basically from about Monday, we saw that pin. See that? Around 22,000. Every time we go low, all those, all those call buyers, they have to buy more of the underlying to cover those put. The put holders, they need to buy more to remain neutral, and then also too, when it got too high and when those deltas change, they had to short. So we saw this pinning action happening the whole time. Okay, again, I was hoping to use Bitcoin as our example. With the order flow and everything, I was going to show this with Bitcoin, but we lost the pin. So now I got to find another example. So I got to go back on demand and find a place on like SPY or something. It usually happens a lot on indices where there's a lot of options participation. So I will try to find an example. I didn't actually have time to go on demand. Again, I thought I was going to be able to show you guys on Bitcoin, just on this. I thought the pin would hold, but I guess not. Animal spirits have taken over, and people are just buying calls like crazy. 23,000 now calls, getting a lot of action for this week. Look at that. Woof. Look at that. That is some action. People are betting hard on this, okay? Let me see if there's any questions. Can you show a real-world example of finding the gamma? Okay, so yeah, I mean, again, like, okay, so like, I wish there was like go back in time feature on Deribit, just like, think or swim. But if you looked at yesterday's numbers, or even like before, like right before the market opened, there was actually like the most of the volume was around here. Your biggest volume number was actually around here. On the puts, it was 591. Actually, here, I think really early in the morning, like in the wee hours of the morning, this actually said like 800s, 900s. This is only the volume on Deribit. They only report the last 24 hours. So probably like, from now, like maybe like 28, 29 hours ago, something like that, right? Maybe about, a day before, some of that was counted. And so, in the wee hours in the morning, it said actually around 800, and there was this wasn't as high. This was nowhere near as high. And the two big volume strikes were 22,000 on the call side, 22,000 on the put side. That's how I saw the pin. Okay, that's how I saw the pin. And not only that, on the order flow, you actually saw primarily a lot of buying and selling back and forth of these puts and calls at 22,000. That's how I know it was a pin. And then also too, if you look at the price action, boom, 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 it's just going around that 22,000 strike. So not only, that's what you look for in a pin. You look for the highest volume being at the money on both the call and put side. You're seeing lots of orders buying and selling on the calls and puts of that strike, and you're seeing the price just bouncing between that. That's how you know it's a pin. Okay? I hope that adds a little bit of color. MSC, does that kind of I know that doesn't fully answer your question. Again, for maybe next time I'll try to find an example of when that happens on SPY.
Yeah, that'll work.
Yeah, but that's how I found this one, at least earlier, and as of yesterday and even wee hours of this morning, this was holding. But then, literally, when was this? Oh, literally 2 hours ago. It must have been 2 hours ago. Just call volume, just going like crazy on the July 22nd, 23,000. So we shall see what happens. We shall see. I am not sure what is going to happen to that. I think, our Australian dollar is coming back up again. Look at that. But
Called that in the cryptocurrency channel 2 hours ago.
Say that again?
I called that in our cryptocurrencies channel 2 hours ago.
What? About what?
Pop that was going to come.
Oh, the pop that was going to come? Yeah. Yeesh. It is what it is. There was a divergence in Bitcoin and ETH. ETH might pop to the upside soon because Bitcoin and RTY are following. Okay. Yeah. So definitely, I do think that there's a lot of, animal spirits in Bitcoin now. Call buyers coming in. And we saw this too. Remember about a week or two ago, I said that, or no, it was like last week over the weekend. I said there was huge block orders for Bitcoin calls. Generally, when you see these institutional block orders, they tend to be a little bit early. Why are they early? Because it takes them time to build positions. Okay, and as you can notice, because I'm institutionally trained myself, I tend to be a little bit early too, and I also build out positions over long periods of time. That's just my style because, again, I used to do this, at an institutional level. Does it always work all the time? No, but it does help with risk management. Now, the reason why they take so long to build a position is because, they don't want it to get noticed. So for them, in order to build these positions, it takes weeks and months to build this position. I'm not saying that's what you should do. And, even for me, I don't take weeks or months to build a position. I try to, one of the advantages that we have over institutions is we can pick and choose with a little bit more control when we enter. Okay, even though we may not exercise that control, we may not have the discipline to exercise that control. We have we do have the option of waiting for certain levels and entering big on those higher quality entries. Institutions don't have that. They don't have the luxury of that. They have to take what they get based on the data. Once they see the data rolling over, they can't really wait for the right price because that window may be too small for them to build a position. So they have to pre-build positions and try to build them over longer periods of time to not get noticed. All right. So that's that's a little side note. One of the advantages that we have as retail institutions, we can actually beat the hedge funds. Okay, we actually have an advantage over hedge funds actually, or over large institutions. We just have to know how to use that advantage. Okay, so that's my plan. Okay, let's go through the positions one more time. Okay, again, Baidu, thank you, Baidu. Baidu has paid for all my positions. Well, not all my positions. It has paid for 2 of my positions. I did add more into our Dow Jones Industrial Average October spreads. We are still in the 300s and 290, long the 300, short the 290. I did buy some more yesterday. All of my Dow Jones Industrial spreads and all of my FEZ, the Euro spreads, are now paid for by those Baidu profits. Okay, I still have I got into this yesterday a little bit too early. I'm like, this drawdown. 32 long the 32 puts, short the 27. Okay, I think I'm down about 10 or 20 cents each. I got them for about $1. Okay, but it's all paid for, so I guess I can't complain too much. I'm still in UVXY calls call spreads. Long the 14, short the 24. Long the 15, short the 20. Still the same as usual. Okay, nothing has changed on that. What else? I'm still in EEM. All right, I'm still in EEM. March, 39 puts. We're at about break even on these. And then on FXI, we still have those put positions. Last week, remember, I rolled this from August to September. And I still have my November 31, 25 put spreads, long the 31, short the 26. This is at a slight profit. This combined, the whole thing combined is still at a slight profit. My plan is I'm going to exit if the Australian dollar closes over 6903. I'm going to exit the FXI and EEM puts if Australian dollar closes over 6903. If the dollar index closes underneath the 18-day moving average, I'm going to exit all put positions in risk assets. Okay, I'm going to just exit all of them if this goes below, it closes below this, the 18-day moving average. Okay, so that's my plan. Oh, and also to SPY, instead of legging in at 395 more aggressively, I am now, if the dollar drops, I'm going to wait for 415. I'm going to wait for 415 to enter into put spreads 3 to 6 months out. All right, I'm going back to our patient approach. Okay, so that's all she wrote. Boom, checkmate. Okay, so that's what I'm looking at. That's the changes I've made, and we're gonna stick to that, and we'll go from there. Okay, we'll take things one day at a time. I'm gonna know, again, I think the indicators are dollar, okay, euro. Again, dollar coming down, euro going up, bullish. What did I tell you guys last week about our indicators, right? 2 out of 4 were screaming bullish. That's when all the data was already changing. Now it's getting even more. This is actually sending a bearish signal with rates and yields actually inverting even more. But that's just one data point, okay? Also, too, in our junk bonds AD that we're tracking, it is neutralizing. Okay, it is neutralizing. It's starting to get flat. It's just bouncing up and down like this. Okay, we haven't had a flat period in a very long time, since January or so. Since around here, we haven't had a flat period like this in a while. Okay, you could say January, or you could maybe even consider this to be a flat period. But that one, it was curling down. But this is a flat period, so it's neutralizing. Even junk bonds AD line is neutralizing. Okay, so we got 1 neutral, 1 bearish, 2 bullish indicators. All right, it's getting more and more bullish. All right, I'm sorry to say it is. I know. With all our puts, right? I know. But it is what it is. It's not about our opinions. It's about what the market tells us. Okay, in the end, we do what the market tells us to do. Any questions, comments, rude remarks? Going once? Going twice? Sold. Okay, all right. Well, this ends High Noon Highlights. If you're joining us from Twitch and YouTube, join our Discord. We have conversations like this. I do also send out our alerts via Discord. That's the fastest way of getting those alerts. I'll still keep our Twitch stream going so you can see the charts and data that I'm looking at throughout the day. And we'll be back tomorrow, same time, noon Eastern time, for another episode of High Noon Highlights. Have a great day, ladies and gentlemen. Stay safe.